Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me to discuss what's next for the U.S. economy relative to the EU and market behavior is James Knightley, Chief International Economist at ING. James, it's great to have you with us. Welcome to Trade Talks.
Yeah. Thank you very much.
Let's take a look at the EU versus the U.S. as they are telling two very different stories.
Yeah, that's right. I mean, we think, the economic impact from COVID-19 has been vast in the United States, the peak to trough fall about 10%. But if you look at parts of Europe, it's been almost twice as big. In fact, it has been more than double that in the UK and in Spain. And I guess this really reflects the fact that we had to have much more aggressive and much longer lockdowns in those countries than we have had in the US. But thankfully, everywhere now, we are seeing a reopening, and that pent-up demand as we all escape from the confines of our home is starting to come through. So we're starting to see some better numbers right across the board.
But if you take a closer look at the U.S. economy, it doesn't look quite as good for the consumer, which of course heavily impacts GDP.
Yeah, that's right. I think there's three key areas that we're a little bit nervous about. One is consumer confidence. As we've seen the reopening across many states, well, of course, that's led to higher numbers of COVID cases, and we've seen state governors choose to roll back on some of those reopenings. So there's the anxiety about the virus, coupled with the fact that businesses have had to close once again, and that means some job losses. And that's my second concern, is that employment has plateaued, really stalled if you look at the high frequency data. And then there's the income question as well. The benefits, that $600 per week has ended. It's being replaced by something smaller. So you've got a combination of weaker confidence, plateauing employment, and an income squeeze. And that to me suggests that we should be looking for perhaps some softer numbers over the next few months.
And James, with that said, what's your thought on the shape of the economic recovery?
Yeah, I mean, if you look at equities, very much priced for a V, but I think as we enter the second phase, after that pent-up demand story has faded away and we look at underlying fundamentals, I just get a sense that we're going to be seeing some weaker growth, a more challenging environment for growth as we go forward. So, yeah, we're still looking for a positive story through the rest of this year, but it's going to be at a much slower rate. And I think, looking back to the global financial crisis, we've got to remember it took nearly 4 years to recover all of the lost output. It's going to take a number of years for us to recover all of the lost output this time as well, I believe.
Well, it seems that generally economists are in agreement that it won't be a V-shaped recovery. So why are stocks trading like the COVID-19 lockdowns has not impacted the consumer and the economy? As you mentioned before, tens of millions of Americans are out of work, and many of them will not have jobs to come back to. They run the risk of evictions, no stimulus help. Why is the market trading at all-time highs?
Yeah, it is remarkable. The most logical conclusion you come to is that, there's so much money out there, and that money has to find a home somewhere. And with bond yields and treasury yields at such low levels, there is still an attraction for equities that are delivering positive earnings. So I think that story is still one that's very, very prevalent as the hunt for yield continues. But there's, as I said, the data flow, we've got the uncertainty of the election. And as you mentioned, there's a lot of structural issues still in play. How will the economy evolve if we're working from home more, if we're not traveling as much, that sort of aspect. And I think, that could lead to a more difficult environment for equities later on in this year.
Yeah, so, and that's what I want to wrap up with. Is it possible the market got it wrong?
I think, the market is in a position now. I think there is the scope for perhaps a slowing in the rate of appreciation of equity prices, and there could be some modest corrections in the meantime. But at the moment, where is the alternative? There's so much money out there. Where does it go? And that's the battle, the difference between the fundamentals and the liquidity story. I think it's just going to be a more difficult environment after a very, very vigorous equity market recovery.
All right, James, appreciate the insight. Thanks for joining us on Trade Talks.
Pleasure. Thank you.
And thanks for joining me. I'm Jill Malandrino, global markets reporter at Nasdaq.